This session is term sheets. Is it New Zealand versus New York? No, we'll just say it's a collaboration, New Zealand and New York. So I'll welcome up Bruno, who's the chair of Angel HQ from Avid Legal, and Josh, a second time back from New York. The first time was 1993, and he says nothing's changed. So that's it.
You don't get me, man.
And you look just as young. No, just kidding. All right. Okay, hand over to you guys.
All right, so today I'm not going to delve into the legal too much of this equation. It's been a really interesting session this morning. I think what's really shone out and borne true is the diligence process and how much time of this alignment needs to be created through that process. And I guess the headline point is really trying to get the term sheets to keep everyone on that road where they get alignment as part of the equation, rather than trying to force alignment through term sheets or terms as part of the equation. It's a good process as well to check on alignment as you negotiate over terms. Good to understand how the entrepreneur reacts to different terms, how they approach putting forward their position as part of the equation. But fundamentally, the hard work should be done prior to getting to the term sheet stage around that alignment itself. And then really moving at that stage of keeping the alignment on track and trying to avoid people pulling at the steering wheel too much to pull the car or veer the car in too much of a direction one way or the other as part of the equation. In the New Zealand landscape, the best way to probably describe it is that there's been a steady refinement of terms rather than any sort of market sort of change in terms in the last year as part of the equation. Generally driven out of trying to create efficiencies in deals. We've had, on last count, about 11 lawyer jokes this morning. The fact of giving lawyers more money to do term sheets and investment documents is not appealing. We get that as part of the equation. So we're trying to get to a position that's a lot cleaner. Still needs to be a sensible one for people, but having people talk about the real conversations and the real issues associated with why terms are required, how often they actually are used as part of the equation is another big one. And the reality is that the term sheet or the investment documents are not a proxy for creating the relationship and having that relationship, which is the thing that's actually going to probably save you most times through the bad times. In terms of what we're seeing in the marketplace, pricing is still first and foremost on the list. In terms of creating alignment, it deals with how your cap table is going to shake out in future rounds. It'd be interesting to see from some of the New York guys, Brian in particular, sort of how much time they spend in that diligence process around setting valuation against capital strategy, against actual diligence on the team and the product itself. What we find a lot of time in New Zealand is a lot of people don't spend the front end time. They give enough to the deal to get it through to the next stage, or they think they've got enough in the deal to shoot the lights out, but it's still woefully short and they still don't know where the next round of capital is ultimately coming from as part of that equation. And so what we're probably seeing a bit more in recent times is a bit more bite-sized pieces in terms of funding rather than tranching itself, but just smaller rounds, partly due to the sort of scarcity of capital, but also people wanting proof points. So go and do a very short, sharp round, get some proof points, and then show how you're going to replicate that in your next round and tell the story around that, rather than trying to get all the money up front as part of the equation. Board rights, again, we're seeing, obviously, investor directors. We're seeing relatively balanced boards come out between sort of the investors and the founders, and then using the opportunity to have independent directors appointed with the agreement of both of those parties to try and round out that situation. And the reality is, again, that's forcing the relationship play. If you're not actually getting around the board table and working together constructively, you're going to have bigger issues going forward in terms of the venture than some of the sort of immediate challenges with customers and things like that. So it's going to be pretty dysfunctional pretty quickly. The independent sort of, it's not the saviour, but it just brings a different head, different perspective around it. The one thing we have seen, particularly around independence, is from both sides of the equation, people fall out of love with independence, usually when the independent doesn't agree with the particular director that's trying to put forward their point of view. Still pretty powerful as part of the equation, and what we also find is really powerful to only be able to sack the independent if the two nominated directors sort of agree to it, or if there's some sort of process through the through a shareholder process, which is usually something north of a general sort of ordinary resolution and probably a special resolution as part of the equation. Reserve matters. We've seen the list come down. When we first started doing these a wee while back, you used to have a big laundry list as long as your arm of different things, and basically you couldn't do a lot without sort of going back through the board and getting the investor director approval. That list is truncated to sort of more material matters now. Again, issue of shares is probably the big one on that list, but again, we're finding most deals, people are getting pretty comfortable with the concept, as long as you're able to still go out on a pro rata basis and offer out to everyone to participate in the deal, that people are still allowing that to be on as a reserve matter, but also allowing that safety valve in the equation, and then trying to, again, build better processes around valuation. The reality is, NNZ, there's not that depth of capital there. So trying to control some of the things becomes a bit of a moot point, because you're going to ask the same people anyway as part of the equation. Pref rights, general majority of cases we're seeing prefs are over ords as part of the equation. Keeping things pretty simple in terms of a non-participating pref, 1x, which doesn't shoot you in the foot for later rounds. It's a relatively standard request. It's a recognised request, so if you are doing something in the US, you're not going to suddenly be setting a tone or a expectation of something higher as part of the equation, and generally you'll get folded into the preference stack over there as part of the equation as well. In terms of no dividend preferences, sort of are still slightly different to the US in some regards there, and we don't really focus on that as much, and we don't see that very often popping up on deals. And no additional participation rights. But what we are seeing on participation rights is, and it's slowly starting to take place here, is actually gating the criteria who can apply and be a part of the next round. So as share or cap tables sort of get more fragmented and you get lots of rats and mice shareholders on there, you're setting a sort of de minimis of sort of 2% of those who can actually then, you've got to have over a 2% holding to then participate in the next round if to have pro rata right, or preemptive rights, sorry. Vesting still remains a pretty good feature in the landscape. It's going to have some challenges going forward with some of the IRD sort of reforms around ESOPs, and that still needs to shake out and flow through. But the reality is it's becoming more of a common feature, which is good, and it's recognised, I think university on the founder and investor side as being useful, and there's plenty of good examples out there where shares have been zapped back, and the fundamental principle is trying to get enough gas back into the tank to then deploy onto somebody else who's actually going to take the company forward if somebody leaves early as part of the equation or doesn't perform. We're still seeing a reasonable amount of haggle around the triggers associated with vesting, but at the same time, most people have been pretty good about it. It's usually around longevity rather than KPIs. If KPIs are possibly used in short term rather than longer term, because it's too hard to try and predict as part of the equation. And depending on where the company's at and what stage it's at, usually a portion of the shares already held by the founder will be banked and outside of the vesting regime. Fully diluted still crops up, and I see on probably most deals when I talk to angels as well, they still don't really get their head around it, particularly around the ESOP and how it plays out. So it's just, again, it's a thing to understand and try and understand if there's a reservation for 10% for an ESOP, is that post-money, pre-money as part of the equation, who's going to get diluted through the equation, because it does impact upon the price, it does impact upon the cap table ultimately as part of the equation. And what we have seen as well is in later rounds, the share scheme is being used, the ESOP's being used to replenish founders who have been diluted out a bit too far, particularly if you go over the US and doing Series A and Series B rounds over there. They want to make sure there's enough gas in that tank to see the journey through, so which does generally mean that all other investors get crunched. So it's just something to be mindful of in the background. And the convertible loans, well, we're tearing them all up after this morning's presentation, which is great to see because they can be quite finicky and tricky, but we still see a place for them genuinely as a bridge for around that sometime in the next 4 to 6 months max, rather than a hedge your bet strategy, because the reality is you still take on largely the same risk profile associated with making the investment, because if the company fails, yes, you may have debt and a head of shareholders as part of the equation, but if it's worth nothing, it's still worth nothing. So it's trying to get that balance working right and getting the right mix of discount in there in the equation. And then ultimately, the biggest discussion we have on CLAs usually is around what is going to set the terms of the next round, and what degree of materiality does that need to be. Who's going to be the one that's smart enough that's going to then negotiate the terms that everyone's going to fall in behind as such, including price, but not only price itself. That's fundamentally it from an NZ Inc. perspective. Interested to hear the New York story and see where we go from there.
As you said, I'm Joshua Siegel. I'm the general partner for Rubicon Venture Capital in New York. We are a bi-coastal firm, San Francisco and New York, and we invest primarily in software companies, late seed A and B rounds. So a lot of what has been said is pretty consistent across the ecosystem, even in New York, but there are some distinct differences in the vernacular and how you use the vocabulary that you're using. I just want to point this out now before people forget. The concept of participation rights has absolutely nothing to do with your ability to invest in the next round of equity. That's not what the term means in the United States. It has to do with the amount of money you will get in the waterfall, so when there's an exit. And I'll go through that more specifically when I present this, but this is just an example of the different meanings of words in different ecosystems, and it's really important as you prep your companies to get out of your local geography into the US, into Europe, even into Asia, that you communicate effectively to the next investors. Because if you say, yeah, we have participation rights, you might kill a deal without even getting to a conversation, okay? So it's really important to be able to do that. Things we're going to talk about is valuation, nuances in the term sheet, the denominator, which is a very important element of all funding rounds, not so much in a priced round because it's well established, but certainly in convertible and safe notes. And then there's a down round situation, which a lot of companies do go through and they don't even know it, and the investors don't really know it. So just taking it in order from left to right, when you have a term sheet, the valuation is really a big factor, especially at the early stage. If you value a company or really overvalue a company too soon, you can have a real problem when you get down the road and you want to do a $5 million Series A round, which is typical in the United States, and the founders are not prepared to give up anywhere between 20 and 30% of the company. That's typical math for when you're doing an A round. And so if they have raised money at too high a valuation, they can almost kill the situation with a Series A because there won't be enough equity left in the deal to motivate the founders. So you really got to be careful about how you get into a company, how you value it, cap versus a priced round, or things of that nature. Other things that come into play with the valuation are the interest rate and the maturity if you're doing a convertible note. Make no mistake, convertible notes are debt, so they have to follow the debt rules, at least in the US. Here that may be a little different. Has to have a maturity date, has to have an interest rate. If it's a safe note, that's not debt, okay? And it's not even really a warrant either. So if you go into a deal on a safe note and the deal loses, you might have a difficult time writing it off. That's something that we worry about in the US. You probably don't worry about that here. But you want to make sure that the founder knows he's on the clock. He's got 18 months or 2 years or 1 year or whatever it is to make sure he increases the value of the company such that he can get follow-on capital. Without that maturity date and without that penalization of the interest rate, he might not be as motivated, okay? So that's really important to do that. Price round valuations, pre versus post. Simple math, you're raising $5 million at a pre-money of 10, post-money is 15, but then there's all kinds of things in there such as employee stock options, warrant coverage, all different things that may be floating around that aren't really in the cap table yet, that really need to be in the cap table. So that's a nuance that you have to make sure that you understand and the founder understands. So very important. I'm going to shift down to the denominator real quick, and then we're going to go to the other side. So in price rounds, you have your price, and then you have your fully diluted cap table. You know what you're getting. $1 is $1 is $1. No problem there. Convertible notes. So Brian, where are you? Is Brian around, or you take a little break? Okay. So Brian and I have known each other for years, and we're always on opposing ends of this. I actually encourage convertible notes at an early stage of the company. It is, as long as the notes are written correctly, it's a great tool. It's faster, it's easier, it's cheaper. You can get all the protections, or virtually all the protections, of a priced round if it's written correctly, okay? And you have to worry about that. One of the big things is the denominator. So in a convertible note, you'll have a conversion equation and a discount rate and a maturity, okay? So the company will say, I'm raising $2 million on an $8 million cap, 18-month maturity, and 5% interest rate. The problem is if it is issued a certain number of shares under that note, it may convert only for those shares. So let's say it has 10 million shares, $8 million cap, they're worth 80 cents. As the company raises more money later on, those shares, those notes, those warrants, whatever it is, may not be included when it converts. So when it converts into the Series A preferred shares, you actually might get in at a higher cap than you otherwise thought. So the whole idea of an 8 million cap or a 20% discount can be a lie, okay? And you really have to be careful. So the only thing you really want written into that conversion equation is price divided by a fully diluted cap table. And that'll save you the trouble of anything else. Safe notes are really bad about this. They only convert, the conversion equation is only for the shares issued under that safe note. So they can issue lots of safe notes, and then you really have a problem. So we don't do safe notes. I don't like them. I encourage nobody to do safe notes. Convertible notes are okay as long as they're written correctly. Nuances in the round. So participating preferred. Participating preferred has to do with a liquidation preference and how you participate in an exit according to the waterfall. So if you have 100% participation rights and a 1x liquidation, that means that you're going to get all your money back. So if you invested $1 million on a 9 million pre, 10 million post, and the company sells for 20 million, you're going to get your full $1 million back, and then you participate equally in the rest of the waterfall. So you're double dipping in essence. So it's good for the investor, not so good for the founder, but when it exits in a large amount of money, it doesn't matter. But it's a great way for VCs to protect that instant 1x on any amount that they've deployed. You don't really see that as much anymore in the Valley. Participation rights really just don't happen that much. In New York, they actually ask for them quite a bit, and it's either 100% or 50%, so the founders can fight for them. Here, I don't know if you do that. It may not be seen. If you do that, it's going to penalize you in the next round of funding from the professional VCs in the US. They'll make you give it up, okay? Or they'll ask for the same thing, and that hurts the founder, and it may misalign interests. So you got to be careful. It's a very sophisticated thing. You don't have to ask for it. It's not going to matter all that much. But if you can get it, as long as you don't piss off the VC later on. Pro rata rights is just your ability to invest later on. Brian mentioned earlier that founders should protect their early investors. I'm 100% in agreement with that. So, you can ask for it legally. A lot of times it is in term sheets, but the reality of it is if a VC comes along and wants to take a bigger piece of the round later and they want that and they won't do the deal without it, you give it up. You go along to get along. So you might have the legal right to do it, but you may not really be able to exercise it. So it's a nuanced sort of thing. Liquidation preference goes hand in hand with participation rights. The only difference is if you have a 1 or 2x liquidation preference and the company is sold for less than what the post-money valuation was before, you're getting a liquidation preference and then nothing else, right? So that is a way to protect yourself. in a down round situation, in a exit where it was less than the post money, or in an acqui-hire situation where the founders are essentially getting more money for being hired into a company, and the equity holders aren't really getting much. So it's a way to protect yourself in that. Dividends are really important. Typically what you'll see in preferred round financings is 6 to 8% dividends to be declared by the board of directors at such time later. It's a great way to pad the waterfall effect. So if you're in a deal for 3, 4, 5, 6 years and you've put $1 million in and it's 8%, you just got another 40% of your money back. Typically it's in cash. So it's a great way to augment returns. Every single term sheet I've ever seen that's in a preferred round has it. It's a great way for us to ask for it. The founders don't necessarily understand the fact that even though it's undeclared, as soon as the exit happens, the board declares it. Happens every time, okay? You can do that too. It can be in your term sheets, and it's okay. It's not a deal killer for us, and it's a great way to augment your returns. So I would encourage you to look at that to a certain extent. Vesting is really important. I've spoken to a number of people over the last couple of days where you have a lot of founders or directors that are out of the company now, and there's a lot of dead weight in the cap table. Vesting is a way to get rid of that. You have what's known as a 4-year vesting period with a 1-year cliff. So when we invest into a company in a preferred round, which is typically where this starts, the founders do not get credit for work they've already done, right? They have to earn it because we're betting on the team and the execution, not just the product. So what happens is they'll get a certain amount of credit. They have to stay with the company for a year, and they will earn that. And then after that, they'll get a sliver of credit every month for the rest, okay? Sometimes when you do rounds later on, they'll restart the vesting as well. Happens a little less so now because there's more time in between rounds, so they get credit for that. But that's a great way to make sure that you don't have any dead weight on the cap table. If you do have dead weight on your cap table, reset the cap table. So, the law is probably very similar here. Just have the founders start a new company or issue a new share of stock and just, crush the early founder who's no longer providing any benefit to the company. So important. Information rights is something that we ask for all the time. It's great when you're an early angel or an early VC and you're in a company and everything's going good and they tell you things are good. And then you ask for the bank statement or you ask for the audited financials, which some of them have, some of them don't. And they take 3 months to get back to you or they never get back to you. Information rights are key. You want to be able to have that transparency with the company and you want to ask for it. Sometimes you'll get it, sometimes you won't at this early stage, but if you're doing actual price rounds, you will get it. A nuance of Delaware law, and we predominantly only invest in Delaware C Corps, although they can be from anywhere in the world, you would want them to be a Delaware C Corp, and anyone can open a Delaware C Corp. You can be from anywhere. Information rights are inherent in Delaware law. So you don't need to actually have it spelled out in the term sheet that you get it. You automatically get it. And all you have to show is that you own 1 share of stock and you're entitled to see every financial document of the company. Okay, and there's been big fights about it recently and big articles in the Wall Street Journal. But inherently you want to have this anyway and be able to communicate with the startup as transparently as possible. Down rounds. So this is where liquidations preferences come into play. You want to make sure you maintain that in a down round. If you have to give it up for the next amount of capital coming in, give it up because otherwise that company is probably going to die, right? So you want to make sure that they have enough capital such that your stock, which may not have as much value anymore, at some point has some sort of value. Pari passu means just everyone is treated the same. Okay, that's not exactly true when you're looking at a cap table and the waterfall. Last money typically controls, and you go along to get along, or you pay to play. So if they're doing a down round and you want to maintain your ownership or even maintain your conversion feature, you might have to put up a little bit more money. The challenge is, should you put up a little bit more money? Don't be afraid to walk away from a deal. Don't have fear of missing out. There's thousands of deals. There's great companies. They're not your children, right? So maybe it's the redheaded stepchild. I don't know. But don't be afraid to walk away. You have to be able to turn off the spigot at some point, right? Let's see what's here. Effects of the term sheet on the next round. So again, pricing comes into play. If you price it too high, you may not be able to get a good enough price in the next round such that the management team isn't overly diluted and they still, have a reason to stick around. I'm trying to just see what other things I put on there. Runway in months. Good rule of thumb, depending on the round, is to have at least 18 months to 24 months of operational capital. That does not mean that you look at the pro forma, the Excel spreadsheet that they've put together that says, well, we're going to take your $1 million in 6 months, we're going to be making $250,000 a day, right, or a month, or whatever it is. No, that doesn't fly. You can make a spreadsheet say anything you want. Assuming zero revenue growth, or zero revenue even, 18 months to 2 years of operational capital. Now, at the angel stage, some of the companies last night were raising for 9 months, a year. Maybe you're willing to accept that at a risk with a lower price, and that happens, and that's kind of what angels are good for in that regard. But when you're getting into a little later stuff, give them time. Pivots happen. People die. People get divorced, all right? Stuff happens. So you have to give them as long amount of time as possible, especially if they're entering a long sales cycle, so you don't know who's going on there. You want to make sure they meet their expected milestones. So a lot of times companies will come and be like, well, we're doing a bridge round. Well, you're bridging to what? And typically we'll look at the last round and say, well, what were the expectations? You didn't meet them. What makes us think you're going to meet these expectations now? So make sure your founders are realistic and make sure you have realistic expectations as well. Push back on these guys. Don't just assume that they're telling you they're going to grow 100% month over month. And there was a hiccup once. Well, there's going to be a hiccup again. It's a problem. So you got to make sure that. Definitely try to figure out the valuation in the next round, and you can usually reverse the math. So typical dilution for the first couple of rounds of capital, even leading up to a B, is anywhere between 20 and 30% of the value of the company. So if they're raising $5 million, you might get a $15 million pre, you might get a $20 million pre, you might even get a $10 million pre. You're not going to certainly get anything less than that, and you won't get anything more. So you can back into it for that. Know who you want to raise from again. The biggest challenge in venture, anywhere really in the world, is making sure that a VC can invest in you. Not whether they want to or not, but can they? Because a lot of VCs have a policy they won't invest in a competitor. So if they've already invested in this guy over here who's doing a similar thing as you, they will not invest in you even if they like you, right? They just can't do it. So if you're going to try to do another startup in the Uber space or something like that, there may not be a VC available to invest in you. So you should really try to figure that out sooner rather than later. And if you can't see that now, that's one of the danger signals for one of the reasons for not investing into one of these early deals. So you got to be careful about that sort of stuff, all right? Definitely fight for valuation. Try to get the lowest valuation possible without screwing up the cap table. You want to try to get your dividends. It's just, icing on the cake, which is great. Again, participating preferred really isn't done in the Valley anymore. In New York, it's a little bit more. Here, I understand it's not really done, so it might not be a thing. Definitely make sure you get a vesting agreement put in place. Typically founders, and I don't know if it's true here, but it probably is, they're friends, they're buddies. One of them's going to use their dad's attorney or something like that. They don't really have an independent attorney, which they really should have. They're splitting the company 50-50. Well, in the US, if you are a founder and you split it 50-50 and then you go to get money, you actually own zero of the company. You don't own any of it until you have a vesting agreement in place and the investor has agreed that you have vested your shares. They just think, well, I own 50%, I'm going to go ahead and leave. It doesn't work that way, okay? So you want to make sure that you have that. Employee option pool, typically anywhere between 8 and 12%, and it resets every round, typically. So make sure that's there. And part of that is the executive compensation structure. Don't let your founders say to you, well, I'm raising $1 million, I'm going to pay myself $250,000 a year. That is not going to fly. Typical founder salaries early is 65 to 70 in the US. You might get a little bit more if you have kids, something like that. They have to hit their milestones. And what happens is a lot of founders, especially into the A or B round, will say, well, I'm going to make $10 million this year, and this is what my salary is going to be. And what we do is say, well, if you make $1 million, this is what your salary is going to be. And everything over that, these are the bonuses that you'll get. So you're really aligning them, just like in a public company or something like that, except better, because you have more control over it, of what they're going to get paid. And it sort of brings the founder back to earth to be like, well, maybe we're not going to make 10 million, maybe we'll make 6. So he's promised you something, but now you're talking to him about his compensation and giving him a reality check, and he's dialing it back a little bit. We see that happen all the time. Board control, typically it's a founder or both founders, and then somebody that represents the equity shareholders. If you have a 3-person board, 5-person board, 7-person board, you always want an odd number. At early stage companies, we actually don't like independent directors. It does create a problem because they're not really buying into the company. So you do want to have, in our view at least, your board directors to be either investors or employees. Typically, you have one board member that represents the equity, and then you have, if it's a co-founders, you have 2 founders. Occasionally, at an early stage, you'll have a 2-person board, but then the investor has the trump card at times, but we've never seen a real problem to date. What not to fight for? Major investor rights. So major investor rights would include pro rata rights, information rights. Those are the 2 big things. And you don't necessarily need to fight for them. You get information rights automatically, right? You do have to hire an attorney to get the information usually, but you're entitled to it, right? Pro rata rights, again, if they like you, you're going to get it. If there's not shares available, you're not going to get it. So it really doesn't matter all that much. And liquidation preferences, I encourage everyone to fight for at least a 1x, and the founders should go along with that. Anything more than that is a little egregious. You don't need it. But at least a 1x, which is standard in every U.S. term sheet. You know, we all want a 1x, and everyone should be willing to give that because you're taking other people's money. The thing that you forget, at least founders forget, you have to give that money back eventually. We do want it back because we have to give it to other people ourselves. Okay, so angels is different. You're voting with your own checkbook. As a VC, my responsibility is to my LPs. Right? And that's my number 1 responsibility. So we want to make sure that we're getting at least that back when we're doing stuff. These are the things we want. Again, price ground. We only invest in preferred equity or convertible notes that go into preferred equity. We will not invest in common shares. It never happens when it's initial investment. Sometimes you'll see secondary situations where we'll buy common equity from the founders if we're already an investor, things like that. Or you get these crazy secondary funds that are buying Uber shares and Airbnb shares and things like that. You know, we don't do that. Liquidation preference, as I said, pro rata. In an ideal world, we want participating preferred, but we don't usually get it. We always want the dividends. It's just, again, icing on the cake to get it. Always has to have a vesting agreement. One other thing in the investing agreement is something known as a double trigger. So typically, when a company is acquired in an M&A transaction, everybody vests whatever it is they have because it's known as a change of control. The problem arises when it's an acqui-hire situation and the company is getting acquired for probably less than it's worth, or the way they're dividing up the compensation is the investors will get this much and then the founders will earn out the rest of it, okay? We don't like to see that happen because it creates a real conflict of interest because we and the investors should get some of this. So we put in a double trigger in there in that the founders do not get to earn that out unless their position has been eliminated. So unless they're actually purchased and then there's no job for them. They get treated just like an investor. Otherwise, they have to pay out whatever the value of the shares are to the investors out of the cash. They can earn out and do whatever they want, but we've done our job. We can't risk our investment on their employment with the company. So it's known as a double trigger. Okay? Board seats, typically you want that. Rubicon does not lead at the moment, so we don't care. Usually, if a problem goes to the board level, the company's screwed. Okay? So we don't want to have that. We're typically the first phone call. If something goes wrong in a company, we can fix it. We can figure it out, we can fix it, we can make calls, do our best to do so. So we don't like to have board seats. It takes a lot of time. Typical board responsibilities take up anywhere between 10 and 12 business days out of a year. And that's time that I cannot spend helping other companies or evaluating companies or doing anything else that I'd want to do. So that's a problem. Always want information rates. Target ownership. There's a unique thing for most VCs. They typically want to maintain a 10%, 15%, or 20% ownership structure in a company. We do not. It's kind of silly. You don't need it because you want to be able to deploy your capital to other places. But some of them do want to have that. Again, with the option pool and compensation, you want to ensure alignment. So, that's something you really got to talk to your founders about. Tie them to an employment agreement. Typically in New York and California, they're at-will states, so you can fire someone or hire them, do whatever you want. When it's a founder and they're on the board, much harder to fire them because they own shares, but it happens.
What terms have you seen in angel term sheets that have cratered your deals at a venture capital level?
So two things. One are revenue share agreements, where the company is sharing revenue with a outside company or even with directors or even investors. So the investors are getting active dividend payments from cash flow into the company. That's a no-no. We would kill that deal completely or try to eliminate that, and that would be a real problem. The other thing, would be that the early stage investors get a pref over the later stage investors. So they have their liquidation preference and they stipulate, well, we're going to get paid first regardless of the capital that comes in later, and we would just either eliminate that, but they have to agree to it. And if they don't, we're not going to fund the company. So that can kill a deal pretty easily.
So most instances we see it's part of a shareholder management and investor management process. If you have got terms from a previous round that are actually going to prohibit the next round, so then it's an assessment. Do you want that next round capital? How much do you want it as part of the equation? Another one is similar to the commission side of things is actually ESOP arrangements or option arrangements where they automatically replenish regardless of dilution. And so then if you've got somebody that's just not aligned with where things move in terms of the cap table and the results of the company as such, because they've always got a preserved position.
Okay, great. I didn't hear any mention of price protection or redemption features in term sheets, and I don't know what you guys do, but we always have those factored into our term sheets.
So yeah, that'll almost kill a deal. Redemption rights are not permitted in deals. We won't fund a deal, or we'll kill that right. We won't typically ask for it. It's really frowned upon now. So I personally have never seen it in any of our term sheets. It's just something that never even makes it onto a first round term sheet because all the lawyers now know that it just won't fly with anyone. You're really just hurting the company by trying to ask for your capital back into the next round. And so it's really a no-no.
Okay.
Much the same in ANZ. I probably haven't seen redemption rights for a couple of years. In deals, most time, and as part of that alignment discussion up front, is trying to work out exactly what the founders wanting to get out of the equation, and you're having that litmus test up front as part of the equation that they're not turning it into a lifestyle business. So pulling the redemption rights off the equation and out of the term sheet, which saves a lot of lawyer fees as part of the equation. Value protection, we certainly, most deals over here will still have it. Move to a broad-based or a narrow-based weighted average anti-dilute as part of the equation. Most haggle is then around sunset of it and how that may play out and what are the excluded issuances under it.
Okay, thanks. Joshua, what's your philosophy going into a deal? Do you want to be king?
No.
So what's more important to you in the terms? Is it the governance terms or is it the financial terms?
It's about alignment of interests with the founders. We only go into deals where we have a value add, where we can help the team get customers, generate revenue, add to them, expand, scale, get additional capital, whatever it is. So we want to make sure it's good product, it's a good team, and they can execute on it. We do not invest in people. right? You'll hear that a lot. People are like, we invest in people. That's what we do. We don't do that, okay? We invest in the team plus the ability to execute of the team plus the product, and that's going to equal success. Otherwise, it's not going to be worth it, right? You might have a pivot or something like that, but that's not a good way to look at it. We take a holistic approach. So we want to make sure we're investing in something that is scalable. It has an uncompetitive advantage. We don't want to be a horse in a horse race. We want to be the jet airplane in the horse race, basically. We want to make sure that it's exitable. There's been a lot of talk about that earlier today. That's one of the primary things that we look at when we're looking at a company. Can it exit successfully at an 8 to 10x within 3 to 5 years? That's what we look at. If it can't, we move on. So it's that simple.
Yeah, I think I'd say most New Zealand angels don't want to be left holding the baby. They occasionally are left holding the baby, but it's certainly not the opening position.
Okay. I guess this would be a question just for a show of hands. You mentioned people dying, Joshua. So does anybody in their term sheets in your angel groups have key person insurance as a term of investing? Yes? Okay. Who's the beneficiary? Company. Okay. I've seen where the angel group is the beneficiary, which is kind of interesting. It's an interesting way of maybe getting your money back if the entrepreneur's not performing, just drive his car over a cliff.
Is there anything the insurance industry won't touch?
It's all about the premiums. Right on. Are there any questions out here? Yes?
A couple of questions. One was about the dividend. We don't use that in any of our term sheets, I don't think. Surely, if you give
Even better.
If you give a dividend or an undeclared, what did you call it?
Undeclared dividend.
Undeclared
that means
dividend.
it's not paid out until later.
Surely the founders get that as well. All the shareholders get it.
It's typically reserved for preferred shareholders because it's part of the preferred issuance. You can have common dividends as well, but it has to be delineated.
So when it's paid out,
correct,
an exit, hopefully, it's then taxable.
Yes, so it's paid out typically as cash. So depending on how it's structured, it's just an add-on, right? You don't get shares of dividends. You'll get that cash.
The receiver will be taxed.
The receivable, it's a mixed thing. So the shares you'll get paid out and taxed as capital gains in the U.S. Dividends are taxed as regular income. So it's a different sort of situation. But VCs are pass-through entities, so it doesn't matter.
We have a slightly different situation in New Zealand. You probably know that we don't have capital gains tax if we're investing for companies. The other
you also don't have capital gains tax for a U.S. investment, though. You're not subject to U.S. taxes.
Okay.
This is your last question. You asked too many.
Yeah.
We're cutting you off.
Yeah. The other question was.
Right, I'm here for the day.
Yeah. The other question was VCs. We thought VCs squashed angels when they came in.
So there are big bad VCs, right? I was a professional angel starting in 2007, and I started an angel group called Georgetown Angels years ago, and then we converted into Rubicon Venture Capital. So we're very sensitive to angels. We like angels. They provide a lot of benefits for the companies. There are VCs out there that will just treat the early stage investors, as insects. They'll just be like, all right, you guys did your job, thank you. You don't get to invest again. We're taking the whole round, and we never want to hear from you. Okay? Founders are now trained not to do that. Sometimes that'll happen. It happened to us in one deal. We were pretty pissed about it. We still have our equity, but we weren't allowed to participate in the next round, which was a massive up-round valuation. But you know what? There's another deal. There's always something else. And the challenge is that founder is going to become known as someone that isn't going to protect his early-stage investors, and he won't get funding again, typically. So what goes around comes around.
Take a picture, folks. A venture capitalist that likes angels. Get your cameras out.
Those are our LPs, right?
Robbie's going to put the hook on us, so we got one more question. Anybody? Yes, back there.
Pretty intrigued by the resetting of the cap table. Wondering about that in the New Zealand context. Sounds interesting, but fraught.
I think that was in the context of the ESOP as such. Or, sorry. Okay, yeah. So yeah, you'll have challenges in doing that as part of the equation. It'll come back down to your investment docs and what you go and what your obligations are. At a board level, you've got your fiduciary obligations as part of it. So it's not an easy situation. It's usually come out of a come to Jesus moment in terms of the company not having any cash left and it being rebirthed in a different form where everyone has written off the investment or written off the shares in their own mind, as opposed to we're squeezing somebody out.
You have to be able to have a rational conversation with your co-founder or, the founder of the equity holder. Look, if we don't take this money in and you lessen your ownership, the company's going to die. So your shares are going to be worth nothing. So you can take a risk and they become worth something, or the company will just die. That's why investing agreements are really important, because then you don't need to have that conversation because it's already there, right? Know that now going in and make sure that every deal you do from now on has that, instill it in the money. Or better yet, if you're going to get co-investment from the government fund, let them do it and say, well, you want our co-investment dollars, you have to have a vesting agreement. And therefore, you don't even have to negotiate for it. Right? So there's one way out.
That's great. Well, let's give it up for Bruno and Joshua. Thank you, guys.